Well, I think investors are still worried, in particular if you look at the credit spreads, which are still widening, particularly for the property sector in the high yield space. And that's definitely a sign that it's probably not over yet. And sort of the market is waiting for a sign of the government. I think we have seen Evergrande, of course, spread are widening quite a lot, but then also it has sort of rolled over to some of the other bigger names. And I think that's worrying. And that's what we see also a reflection on the equity market. We had a bit of a rebound during September, but now actually the Chinese market has been quite weak in October, one of the weakest markets here in Asia. So we do think we would need a clear stance from the government to clearly say, okay, Evergrande maybe has been ring-fenced, but it's not spreading to some of the other property names. And we haven't really seen this in a grander scale. We have heard a little bit from some of the policymakers, but we're still waiting for a clear sign. And I think that's what the market is looking for. So for us, it's a bit too early to go back to China. We're still neutral on China. There's value on the equity side particular, and we have seen some good earnings actually can lift prices. But for a bigger and more sustainable rebound, I think we need a clearer sign.
Do you not risk, Adrian, losing out? Because I'm reading the headline from the Financial Times. This was put out, I think, 24 hours ago, saying global holdings of Chinese stocks and bonds have risen by $120 billion, $120 billion in 2021. Money still going into Chinese assets.
Well, I think there's still a value, of course. And what we actually still like is more the high quality part, in particular the fixed income space, like Chinese government bonds. And they're actually still paying a quite decent yield. We don't have probably the same conditions as in the US when the Fed starts to taper and bond prices, or basically bond yields, are going up and bond prices will be negatively affected. It's probably the opposite. The PBOC will have to do some easing. We do expect some RRR cuts are coming up to support the domestic economy, to also ring fence, as said, some of the property names. And that basically would mean that, particularly on the government bond side, that actually yields can even drift a little bit lower, which of course is an added value for people that are already holding bonds. And if you have a longer view on China, 5-10 years, we do think there's value. I think the market has been down 16%. Europe, the US is up double digit this year, nearly 20%. So this gap has opened up a valuation dispersion, which we do actually find attractive from a longer term perspective. But tactically, probably a bit too early.